The West has tried everything to kill Russia's economy.
The EU has agreed to a 13th round of sanctions against Russia.
They've thrown sanction after sanction in the hopes of destroying Russia. Yet, despite all these sanctions, Russia's economic resilience has stunned the world.
Russia has still managed to avoid the financial collapse that many predicted would bring it to its knees.
You see, Russia has consistently stood out as a key figure in the global economy, often surpassing expectations and drawing attention for its continuous growth. Meanwhile, Europe, traditionally seen as a strong economic force, is grappling with a host of problems right now, which are leading to slow growth, fiscal uncertainties, and a series of structural challenges. But why is this happening? In this video, we dive into an analysis of both economies to uncover why Russia continues to prosper despite its challenges, whereas Europe appears to be struggling. Since its invasion of Ukraine almost 2 years ago, Russia has faced significant economic sanctions. Yet, remarkably, Russia's economy has held up well, going against what many economists predicted. The sanctions aimed not only to penalize Russia for its actions, but also to cut off the supply of resources and funds it uses to continue its conflict with Ukraine. So, what went wrong with these measures? And how is Putin's economy managing to thrive during these times of war? As we wrapped up last year, Moscow announced an expected annual economic growth of 2.8%, bouncing back from a downturn in 2022. A year marked by intensified sanctions following its invasion of Ukraine. A surge in defense spending and high oil prices have played a significant role in keeping the economy steady. It seems that Russian private businesses have also successfully adapted to the shifting economic landscape. However, the impact of these sanctions and export controls is being significantly undermined, as Russia uses its allies to circumvent and mitigate the impacts of these sanctions. For example, despite the EU placing sanctions on Russian oil, it's still buying it via India. While trade restrictions have indeed inflicted damage upon the Russian economy, it has shown remarkable resilience, continuing to support the ongoing conflict in Ukraine. Despite Western efforts to cut off investment to Russia, Moscow has leaned on China to bridge some of these financial gaps. Russia's economic situation has been significantly bolstered by its relationship with China. The growing bond between the two countries, which has been strengthening over the decades, became even tighter following Russia's invasion of Ukraine. Both nations have deliberately chosen to enhance their partnership, viewing it as a critical alliance against what they consider a shared threat from Western countries. Due to their strong relations, China has stepped up, counteracting the effects of the sanctions even as weapons and ammunition pour into Ukraine from NATO countries. Russia's dependence on China to mitigate the impact of these sanctions is such that a fifth of its imports by the end of 2022 were reported to have been invoiced in Chinese yuan, while Beijing has markedly increased the use of the currency to pay for Russian commodities. Moscow's economic ties with Beijing seem to be getting closer and closer. So much so that there's now a debate over whether Russia is becoming a vassal state. But for China, India, and other smaller countries eager to step up trade with Russia, commercial opportunity, it seems, is the main driver. Meanwhile, in the West, Europe experiences a different narrative, grappling with tough economic times. And this is why. As the Russian economy holds strong, Europe is heading in a different direction, facing a prolonged economic downturn exacerbated by high interest rates and the ongoing effects of Russia's conflict in Ukraine. From the outset, it was evident that Putin's war would wreak havoc on the global economy. Although its economic repercussions may seem minor compared to the human suffering and loss of life in the conflict, they pose significant challenges. Leaders are now tasked with addressing these issues to prevent further hardship, including poverty, food shortages, and the cost of living crisis. Since mid-2021, global energy prices have been on the rise, driven by increased demand as the world recovers from the pandemic. This has led to a tight energy market, a situation that worsened significantly in Europe due to Russia's invasion of Ukraine. The impact was most acute in the 10 EU countries that rely heavily on Russian oil and gas, while nations that have invested in renewable sources, biofuels, and nuclear power are less dependent on Russian energy. However, Russia still remains an important supplier to international oil and gas markets, such that any trade disruption, sanctions or otherwise, translates into higher prices. At the same time, the ripple effect of higher interest rates on the economy has led to speculation about potential rate cuts. Typically, higher rates are used to combat inflation because they increase the cost of borrowing and spending, thereby cooling off demand for goods. Moreover, higher interest rates can slow down economic growth, which has been hard to come by in the 20 European Union countries that use the euro. Here, the European Central Bank is in charge of setting rates. Recently, the Eurozone saw a slight economic shrinkage of 0.1% and a drop in inflation to its lowest in 2 years, indicating that high interest rates are starting to impact the economy. Despite this sluggish growth, the current economic situation doesn't quite fit the mold of a traditional recession, given that unemployment is at an all-time low and wages are slowly recovering from inflation losses. Workers are increasingly demanding and receiving higher pay. With so many unknowns ahead, economists are busy trying to forecast the future for these economies. Can Russia maintain its economic stability? And is there hope for a turnaround in Europe's economic fortunes? Looking ahead, it seems the Russian economy may suffer from the collapse of technical, scientific, and cultural ties with the West. Western sanctions have left Russia in dire financial circumstances, stuck somewhere between recession and stagnation. Though proven solutions exist for what now ails Russia, President Vladimir Putin's geostrategic and political choices have rendered these traditional economic approaches unworkable in the long run. The main established routes to economic recovery, increasing exports, expanding domestic manufacturing, and attracting more foreign investment, are not currently viable, and it's clear that Russia's savings are not inexhaustible. And other proposed solutions, including price controls or fixed exchange rates, would only make matters worse. The consequences of Russia's war have forced it to retreat from global markets, making it more vulnerable to the demand changes of a smaller group of partners. Pulling back from global markets also restricts Russia's ability to access new ideas and innovations. Without ready access to these key drivers of long-term growth, the Russian economy is primed to fall into a weaker, less productive trajectory. The costs are now higher for Russia to further develop its energy infrastructure and invest in projects that would generate future revenue. What of Europe? Is there any chance of a swift comeback? Following a robust post-pandemic expansion in 2021 and 2022, the EU economy has lost momentum. Real GDP contracted very mildly in the fourth quarter of 2022 and barely grew in the first 3 quarters of last year, with a high cost of living taking a heavier toll than expected. It goes without saying that European policymakers need to remain focused on defeating inflation. Restoring price and fiscal stability are paramount for countries to prosper in a shock-down world, and the policies that governments put in place today have important implications for the trajectory of inflation, competitiveness, and growth in the future. Tackling inflation now will strengthen resilience and help to reinforce competitiveness in the long term. As inflation is brought under control and fiscal space is rebuilt, European policymakers will be able to seize the opportunities posed by big transitions rather than being casualties of these structural shifts. Structural policies that help boost supply, including those at the EU level, ultimately will be the only way of boosting growth and will also alleviate some of the structural inflation pressures. And all this, in turn, will play an important role in raising regional growth and in helping emerging economies to converge with Europe's advanced economies. The surprising resilience of Russia and the challenges faced by Europe present a compelling story. The contrast between Russia's thriving economy, despite facing substantial sanctions and geopolitical isolation, against Europe's drawn-out economic slowdown and the impact of Russia's war in Ukraine, paints a vivid picture of the dynamic forces at play. While Moscow strengthens economic ties with Beijing and maintains its stability through diversified partnerships, Europe grapples with the consequences of its heavy dependence on Russian energy imports and faces the outcome of inflation, high interest rates, and sluggish growth. As the global economic landscape remains unpredictable, these divergent trajectories serve as an important reminder of the complexities nations must navigate in an ever-evolving world, where adaptability, strategic decision-making, and international collaboration become imperative for future prosperity.